Joining me now is Hugh Simon, CEO of Amin Asset Management. Hugh is also co-manager of Dreyfus Greater China Fund, which, by the way, has more than $1 billion in assets. The fund returned about 120% last year, double the gains in the benchmark Hang Seng Index. It's outperformed 96% of its peers last year. Hugh, nice track record there. Now, those Chinese stocks, they've gained, 2% last week, but still lagging behind many Asian markets. What do you make of the correction that we're seeing right now?
Morning, Haslinda. Thank you. The market correction, I think, is quite a healthy one. As you know, that China is tightening, increasing bank reserve requirements for the banks. And this is a useful time to consider what stocks you're holding and that your conviction into those areas, the sectors you're in. Because I think this correction, this consolidation is a healthy one and allows you to look at the domestic growth in the economy. And last year was driven obviously by interest-sensitive companies that were benefiting from the reserve, the banks lending money to the property companies and the infrastructure spending. This year probably more domestic consumption, also a recovery in export, different areas like that.
Where does it go from here, Hugh?
I think you'll continue to see some consolidation, and then you'll probably see higher prices later in the year, probably second, third quarter. So I think what's happening is that profits are rising, companies are reporting very attractive results and leading people to do a lot of analysis in different areas. Obviously, some concerns of higher interest rates coming, concerns over the inflation risk, and also higher wages. But all of those allow you opportunities. If you've got higher wages, higher spending potential, especially in the Pearl River Delta area, as you know, the tight labor market means that the people will be at higher salaries. Also, it means that in the rural areas where people aren't coming back from after Chinese New Year, they're staying there because there's quite a lot of job opportunity in the secondary cities. So look at areas in the secondary cities and the rural sector as well.
Have you made any changes to your portfolio, to your strategy? What have you done to limit exposure to the decline that we're seeing right now?
We're diversifying the portfolio a bit more, increasing the export sector, which could recover, we think. And, you know, as the banks also look to raise capital, start to look at the banking stocks again. And also, you know, you've been talking a lot about the RMB revaluation and the pressure on that. The B-share market obviously is a beneficiary of that. Because if you get an opening and widening of the currency market, then the B-share market should be a beneficiary of that too.
The market's on watch in China, rising inflation, rate tightening, yuan levels, like you mentioned slightly earlier. To what extent do these factors contribute to increased volatility?
There's quite a lot of rotation going on. So the stock volatility, the market volatility is not that high. As you said, yes, it's underperforming, but some of the regional peers. But individual stocks are a bit more volatile rather than the market. As you see, investors rotate out to different sectors. They were sellers of property, and people worried about the property market with tightening coming on, the access to capital by the banks lending. But I think maybe some of those prices have corrected enough, and you'll see investors coming back into the property sector, especially looking at the second-tier cities, the opportunities in those as well.
You talked about tightening. Last week, India raised rates rather unexpectedly. Does this herald more tightening to come? Will this depress investor sentiment, risk appetite for emerging market assets?
I don't think people are depressed. I think that's not the right message. I think people are very optimistic about the opportunities and the profits growth that you're going to see. People, when you get money getting drawn out of a market, whether it's because of higher interest rates, better opportunities in the real economy, then you'll have less liquidity for the stock market. And therefore, you start to see market consolidation, which is what we're having now. But as those profits come through, as you see CapEx being put into different sectors of the economy, then you'll start to see investors return because they'll be supported by the earnings that are coming through. So the market's not stretched at the moment in the sense of earnings. You're at maybe 13, 14 times earnings with decent earnings growth coming through.
Hugh, quick question before we let you go. Trade of the year for 2010, what would it be?
Oh, that's difficult. You'd have to be something. You'd have to be something that people aren't looking at the moment. I would say, okay, maybe B shares or a recovery in Taiwan, and also obviously your currency story.
All right, Hugh Simon, CEO of Amin Asset Management. Thank you for your insights today. Still